Welcome to the Dividend Talk podcast, episode 43, a conversation about dividend growth investing with Ian Lopuch. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to this channel, please hit the like button and subscribe to us, and check out our latest episodes on YouTube and Spotify. See you on the inside. Hey European DJI, the day we've been waiting for is here. How are you?
I'm really doing well. It's a bit awkward because usually we have a recording on Friday, and today the podcast is recorded on Wednesday. But actually, I'm really excited for today, EMF. How about you?
I'm super excited, and I think we should just skip all the pleasantries and go straight to our guest. Ian, welcome to the show. It's a pleasure to have you here.
Hey, thank you guys. I'm so excited to be here today on your podcast. This is going to be a lot of fun.
Well, we're actually so looking forward to this. But I suppose for some of our audience that may not know you, if you could just give us a brief introduction about who you are, that would be great.
Absolutely. Hey, everyone. Thank you for tuning in today. My name is Ian Lopuch. A lot of you might know me as PPC Ian. I'm a YouTuber who presents videos about dividend growth investing, and I've been investing in dividend stocks for well over 20 years now with the goal of eventually living off of passive income from dividend stocks.
Nice, and we have lots and lots of different questions coming about that, so we're going to dive a little bit deeper into that as we go. But at this stage, we usually speak a little bit about the news of the week. So European DJI, have you got anything on that side?
Well, yes, and this might also actually be interesting to you, Ian, because what was huge in the news in Europe this week is about a global tax rate that our politicians are thinking about. They're considering to implement a 21% global tax rate. And I think this is really a big thing, because if you look into the European news, it's always like a little bit like, what will America do? Will they buy in, or will they give us a hard time? It always feels not honest with the big corporations avoiding tax and such. And I think Europe, we've been talking for a decade about it now. And now with the new president, Biden, it seems that there's willingness to work something out. And what was really interesting is that besides the 21% tax rate, they're also looking now at there's openness to discuss also a digital tax. And this digital tax has really my interest, because I own some Microsoft and some Facebook, and I would really wonder, like, what would this do to the tech companies if a digital tax really gets implemented? And we know all what France is trying to do. I think the UK as well, because the general thinking here also, Ian, is that why we are investing in infrastructure and highways and everything, and why would a company like Apple, for instance, not pay any tax while they benefit also from all this infrastructure? So this is a big thing, I think, in the news, and for the first time that I heard something positive on this topic. So yeah, that was really my news from the week.
Yeah, that's really interesting. I would say, like, just from the United States perspective, I think a lot of, I hear this on my channel a lot right now. There is a fear amongst dividend stock investors right now on the topic of taxes, because there's kind of two subtopics here. One is just the overall corporate tax. Under the prior president, President Trump, a lot of the corporate taxes were reduced, and companies were using their savings to make investments. They were using their savings to buy back shares. They were using their savings in many ways. And I would say, from my personal perspective, at least, I'm not so certain these companies were really operating under the principle that the taxes would come back. I think they were really operating like, hey, this is going to be a permanent tax cut. And so I think moving forward now under President Biden and under some potential new tax codes, it does create some level of uncertainty, like what will happen at the corporate level with these companies who are kind of operating now under the prior administration's rules. And then I think on a more personal level, I know a lot of dividend investors right now are thinking, hey, how could new taxes affect me? Will there be a higher tax rate on qualified dividends? Will there be a higher tax rate on long-term capital gains? Will I have more taxes just on my ordinary job income and then less money left over to invest in dividend stocks? So those are the types of thoughts going through my mind and a lot of investors' minds at this time. I would say for me, though, I've always liked to take a step back and just try to invest in the best possible companies and take the best possible approach with my finances, knowing that I just can't control the taxes. It's one of these things that is uncontrollable, that is always going to be in flux. And so it's about just making the best possible decisions, knowing that there is some level of unpredictability with the tax code.
Yeah, same is here. And I would almost say from a European perspective, probably the only way is up, but then in the sense of benefits to Europeans, because we know that Switzerland has a 35% dividend tax rate, Germany 26 and a bit, Netherlands 15, the UK nothing. It's really, really complicated over here to make investment decisions. And it shies a lot of people away from investing in high quality companies. So that's one of the reasons why I only look mainly at the tax-adjusted dividend yield, because that gives a really nice, clean net overview of your portfolio. But Derek, what does it mean for Ireland? Because I think you've got really a specific situation there, right?
Yeah, we have one of the lowest corporate tax rates in Europe at the moment. I think it's 12.5%, and Europe has been pushing really hard for us to increase that. But I mean, we've got companies like Google, Microsoft, Facebook, all headquartered here in Ireland, purely because of this, Intel as well, purely because of this tax rate, the low tax rate that they pay. So I would imagine that we will not sit down and take this lightly. We've been pushing back on it for years and years. I mean, why would a company go and stay in Dublin if they could go to Paris or Germany or Munich or any of these big places with the same tax rate? So that's one of our competitive advantages on this island. So it's going to be really interesting to see how our government navigates this kind of tax regime.
Good. So let's see what gets out of it. But it's a good thing in generally that they are trying to harmonize the tax standards, I think, across the world, because it makes it a bit more predictable and more easier to invest and such, but also run businesses, I think, across countries.
Okay, cool. Is there anything else in the news then that sparked your interest?
Well, there was one little thing maybe still. Credit Suisse has fired their risk manager and the CEO of investment banking after this, how was it called? This Archeos, how was it called? Where the margin call of several hundred billion because of this person in New York. What was his name? His name was Bill Wang from Tiger Asia.
Yeah,
who speculated a little bit too much, and then it has a major fallout across many investment banks at the moment. So Credit Suisse is already indicating that they will probably have up to $1 billion loss because of a single exposure to a single family or individual. And for me, my feeling a bit about banking and banks already since the great financial crisis. And what is so annoying for me is that banks continuously keep having fines and penalties because of violation, mismanagement, and this is just another one in the series. But at the same time, they're increasing the commissions on the accounts and everything. So in the end, I always have a feeling that I, as an individual, pay for it, and I'm really sensitive to my costs because it has an impact on my early retirement date, right? So I think there's more to come here, more fallout, but this is a huge thing. And for Credit Suisse to also fire two directors is quite a big thing again.
It's a lot of money, isn't it? It's a lot of money.
Actually, just one quick note on just that banking topic. It's quite interesting to see in recent years. There's been a lot of scandals. I even own a bank, Wells Fargo. And by the way, I guess in the podcast today, as I share stocks, just in terms of full disclosure, anything I bring up, I typically own. But Wells Fargo, for example, had a whole this whole scandal around, I guess, employees trying to push people into opening accounts and such, and fake accounts. And you hear all of this news about banks. And just as a consumer as well, when I go into the bank, it's such a suboptimal experience. It is so old school that I think as a dividend investor, especially with a very long-term time horizon, I'm always trying to pick stocks and pick trends that are going to stand the test of time. And I think banking is one sector where I do have exposure. I own Wells Fargo, I own a few other banks, but at the same time, I'm a bit underweight there just because of the reasons even discussed today with the news, that it is a little bit of a riskier sector, and it is a sector that will probably be disrupted at some point. Personally speaking, I see the trend of blockchain and cryptocurrency even giving the banking sector a pretty good competition in future years.
Yeah, it's good that you mentioned that, because what we have seen in Europe as well as part of COVID, the central bank didn't even allow dividends to be paid to the shareholders, specifically in France, as an example, with BNP Paribas there and such banks. So from a European point of view, specifically when we look at some of the bigger European banks, I just don't see a case when you are using investing in them when you're using a dividend growth perspective, because dividends, okay, sometimes they are juicy, but you need to know that when I said when there's really trouble in the street, you cannot count on those dividends when you need them probably the most in those times.
That's a good point. And I think for me, what I like to do is have broad exposure to all of the different sectors and asset classes, because sometimes you just don't know what's going to happen in the market. And so there is that element of unpredictability. And so sometimes it's really weird. Like recently, there's been some days where I wake up, I look at my portfolio, everything is down except the energy sector, the oil stocks. And I would have never even thought, wow, that wouldn't happen. And so I do like to have a smaller exposure to some of these sectors like energy and like financial services. But to your point, it is one of those sectors where I'm never super excited about placing capital unless something is on really deep discount.
Yeah, but that's rather, I guess, value investing over dividend investing as a first preference.
Yeah.
Super.
Okay, so at this stage, then we might do the rapid fire question round. So we just ask you, I think it's 5 or 6 questions, 2 choices, and you have to answer straight away which one you want, and then you can talk about them then at the end.
Okay, so let's start. The first question: Warren Buffett or Charlie Munger?
Charlie Munger.
Okay. Second one: IBM or Intel?
IBM.
Okay, the first one, and it's probably a bit more according to one of your latest videos: angel investing or buying a SPAC?
Oh boy, buying a SPAC.
Football or soccer?
Soccer.
The last one then: hip hop from the East Coast or hip hop from the West Coast?
Oh man, West Coast.
Cool. Would you like to elaborate on one of those answers?
Oh boy, sure. So I just took some notes. I would say Warren Buffett or Charlie Munger. They're both amazing investors. With Warren Buffett, for those who have been following my YouTube channel for a while, I think there's certain times where my investing strategy aligns with his. Like Coca-Cola, for example. It's one of those classic stocks where it's not going to make anyone rich overnight, but it is kind of a very steady stock that provides stable cash flow. And I think they're big enough, they're operating at such a big enough scale where they're making some wise acquisitions and some new choices. Like example, even acquiring Costa Coffee, that European coffee shop, cafe franchise. I love that. But it's not going to make anyone rich overnight, but at least my interests are aligned with Buffett's. But I would say in other cases, sometimes I feel as if Warren Buffett, his interests aren't necessarily aligned with the common shareholders. And I don't fault him for this, because Warren Buffett is looking out for Warren Buffett and for his shareholders and his Berkshire Hathaway shareholders. But some good examples are Kraft Heinz, for example. He got into that company in such a unique and particular way where it made sense for him and for his shareholders, but it wasn't really aligned with the common shareholders. And so I think there's this misconception out there amongst dividend investors that if Warren Buffett does something, it must be good for me. And that's, I think that kind of, that philosophy, it applies to a lot of newer dividend investors, but even more seasoned ones. A lot of people feel, well, if Warren Buffett is going ahead and he's buying Occidental Petroleum, I should do that too. But again, Occidental Petroleum is an example like Kraft Heinz, where the way in which he's structuring the deal for himself and his constituents is so different than the common shareholder, where it's not an apples to apples comparison. And so the reason I selected Charlie Munger here is it's really just as almost a word of caution to investors out there, that there's a lot to learn from Warren Buffett, but at the same time, it's important to remember that Warren Buffett is looking out for Warren Buffett and Berkshire Hathaway, and just following his every move, it doesn't always pay dividends, if you will, for just the average common shareholder. And so for that reason, I go with Charlie. But obviously, Charlie's his number two guy, his right-hand man. So he's, I guess I also have an appreciation for the underdog as well. I mean, they're both incredibly wealthy, successful people, but Warren Buffett is the one that gets all the credit. And so I feel kind of with dividend investing, it's that unsung hero of the investing community. It's one of those things where, who do we hear about on the front page of the news? We hear about the bank, Credit Suisse, and we hear about these huge losses. We hear about these traders. We hear about these people doing all these kind of fancy financing, but you don't hear every day about just the unsung heroes. And I kind of look at, I always have an appreciation for the underdog, for the person who doesn't necessarily get in the spotlight, but is doing some really amazing things behind the scenes. And I think that applies really to all dividend investors.
Yeah, super. And I remember also that Warren Buffett because it was with 3G Capital, I think, right? They wanted
That's
to,
right.
they did a bit on Unilever as well 2 or 3 years ago. And I remember that as an investor in Unilever, I was really not happy with it, because they would just take Unilever, a brilliant company, away. While if it would come, I think they wanted to merge it probably with Heinz at the time. It was something like that with 3G Capital. And I knew that the company we get in return as a shareholder in that case wouldn't have suited me as a dividend investor. So I was really glad that actually this deal got terminated, because Unilever, I don't know exactly anymore, but they arranged it like that they couldn't even be taken over at that time.
Yeah,
but it was a similar story with Warren Buffett.
I remember that. I remember that, and I'll tell you another one is Dominion Energy. This is a popular regulated electric utility. I don't own this one, but I know, I believe, if my memory serves me properly, that Buffett ended up buying like part of their company, and when he did that, the company that was left over ended up reducing the dividend. This was a year ago, so maybe my memory is not perfect on it, but that was another case where I think Warren Buffett, he's a brilliant businessman, and he did a really good job for himself and for his Berkshire Hathaway shareholders. But unfortunately, for people who are not a Berkshire Hathaway shareholder, who are just holding Dominion, is it the best deal for them? I don't know. I think so. So that's where folks have to be really careful with Buffett. But another example is Apple. I own Apple stock. It's been one of my best performing stocks in terms of capital appreciation. And there, I feel like my interests are really aligned with Buffett's, because he's a long-term shareholder. I'm a long-term shareholder. I think he's not trying to necessarily break apart the company or make any major changes at the company. And so there are those cases. And quite frankly, I think Buffett has brought a lot of attention to Apple, and he's obviously placed a lot of capital. And so he is probably one of the big reasons behind the stock appreciating so much. And so there are cases like that where investing side by side with Buffett, it's paid off really well.
Yeah, and that comes down again to the old saying of do your own homework. Right? Really look at what you're looking for as part of your own investment strategy, and then figure out if it aligns indeed. Yeah.
Absolutely.
Okay. So maybe this is a great moment to go to some of the questions that we had also for you, Ian. And both EMF would like to actually bring you a little bit to your starting point of your, let's say, investment career. But could you share with us a little bit your first aha moment that you felt like, okay, I'm Columbus, I discovered a new world. It's called dividend investing or just financial independence. Could you bring us a little bit back to that time, how that feeling was, when it was, how it happened?
You know, this is a really long time ago. And so my memory, this was kind of, I don't remember. I think I was like in middle school, not even in high school yet. But basically, when I was going to school, I had a few friends who were interested in the stock market. And so back then, this is like my early, like teenage years, one of my friends had mentioned, hey, Ian, I'm investing in these mutual funds. And so back then, the big mutual fund company that was really successful was called Janus. And they had all these like kind of tech oriented mutual funds that were they were just doing phenomenally well. And so I started looking into it myself, and I thought, wow, this is really interesting. I can place my money in an investment vehicle. And back then, this was so long ago that these mutual funds were performing like they were going up like, anywhere from 20% to 100% any given year. They're performing very well in terms of capital appreciation. And I was like, you know what, this is really interesting. I can put my money that's just sitting in the bank account right now doing nothing into this vehicle and double my money pretty quickly. And so I basically then talked to my parents, and I had their help setting up in the US what's called like a custodial account, because when you're just you're just a teenager, you can't open up your own financial accounts without having a parent or guardian kind of being the custodian for you. And so at that time, I started opening up accounts with Janus. And then from there, I started just branching out. It was an aha moment, honestly, as I started just reading a lot of books, because this was in the earlier days, honestly, of the internet. The internet wasn't fully like developed the way it is now. Sure, there was a lot of information, and there was some really good like message boards. I remember back then, even in the early days, Yahoo Finance message boards, or like at the time they had this thing called like Raging Bull. They had message boards, and we'd read all the conversations there. But honestly, to really get information on dividend investing, it only came to me once I started reading a lot of just old school books. And when I went to the bookstore, one that always kind of caught my attention were the Motley Fool. And they still have a really good website and good information available to this day. But I basically read like every book that the Motley Fool put out. Everything. And one in particular called Investing Without a Silver Spoon was kind of my aha moment, because it's a really thick book, and it was like, hey, because I was just really young, I didn't have any money. And they're like, you can invest with as little as $25 a month. And what they were really talking about were these dividend reinvestment plans. And back then, I really didn't know how to pick stocks very well. I was doing my best, but I think as any new investor, what I've found for myself, at least, is it takes years and years to really cultivate the skill to pick the right stocks and to really know what you're doing. So but that being said, I was learning, and one of the first actual dividend reinvestment plans that I purchased was in Compact Computer. And again, this wasn't the best stock selection. It wasn't really, I don't know if I really had a sound fundamental analysis behind it. But that book introduced me just to this world of dividend reinvestment plans and how it's possible to invest without even paying commissions. Because these days, a lot of dividend reinvestment plans, for those that don't know, these are plans where you can purchase stock basically directly from a company through what's called a transfer agent. Usually a company will appoint someone like EQ Shareholder Services or ComputerShare, one of these companies, to be their transfer agent, and you can buy stock directly. And one of the benefits of that is sometimes you can avoid commissions. Unfortunately, a lot of companies these days, their dividend reinvestment plans, also called DRIPs, they do carry commissions. And so times have changed. But back then, a lot of these plans, they were commission free. And so literally, like a teenager, someone even who just doesn't have much money could get started. Literally, I'm going to invest $25 this month in Compact Computer. And that was kind of an aha moment that just, I can do this. I can start even though I don't have a lot of money, even though I'm smaller investor, and get into this world of finance that was once reserved for all of these big shots. And I guess from there, I just started watching CNBC quite a bit. I started reading more books. eventually, when I went to college at Stanford, I joined the investing group there, eventually became co-president of it. It was a real money investment fund where just networking with like-minded investors provided a world of knowledge. And I would say over the years, I just kept picking up more and more skills. Now, what I would say is in those early days, it took a really long time to really learn everything. Maybe I took longer than most people. I almost feel like I made more mistakes than others because I got into all kinds of things like day trading, penny stocks, those being the two biggest kind of mistakes in my early years, where I was like, well, I want to make money quicker, or the buy and hold investing, it's too slow. And so there's these temptations to try to make money quicker. And I think a lot of those kind of temptations, they especially appeal to like a younger person or, younger guy in college. I'm like, well, can I make more money quicker? And so I feel like for me, I made a lot of mistakes along the way, and I like to share those mistakes on my YouTube channel, for example, so that hopefully others out there can benefit and maybe they don't make quite as many mistakes as I did. But that's kind of my long answer to how I got started in the really, really early years. I would say maybe even before that, maybe it was just kind of a circumstance. I would say for me, there's an element of luck with anything in life. You can do everything, but I was just talking about this yesterday with one of my business partners because I'm always evaluating real estate deals for my job, and we were just discussing how like all of our real estate deals, like we put in so much hard work, so much due diligence. But there's the really good ones, or really any of them, there's always an element of luck. There's something goes right. Because I'll tell you, I just built a real estate deal, and all of a sudden, then after we built it, Amazon said we're coming to town, building huge warehouse and providing all these jobs. And it's just, there's that element of luck like that comes in, and it helps out. And so I would say for me, like in the early days, one of the elements of luck I have is I've been in the game a long time. And the reason I've been in the game a long time is literally I just had some friends in high school, too, in particular, who were into these stocks. I don't know why before I was. And so it got me interested in this in an early age. And then I guess another element of luck is like way back in the day when I was a kid, before I could even appreciate this stuff, my dad at home, he would watch like Wall Street Week with Louis Rukeyser. He would watch that show, like I think it was on Sundays, like every Sunday. I just see him watching this, and it wasn't very interesting. Sometimes I'd watch it with him, but I think at those years, it just kind of planted a seed, that there is this opportunity to invest in stocks and bonds and financial instruments. And there's this whole world, and it kind of exposed it to me at an early age. So maybe when my friends were investing in those mutual funds, that it set me up, just that I'd seen that before. I understood what it was. And so I'd say there's some element of luck just kind of getting into the game pretty early, and thankfully making a lot of my mistakes earlier on before I was dealing with larger sums of money.
I mean, that's an incredible story, to be fair. And I have a kid myself who's, I think he's 10 now, and he's interested in stocks at such a young age because he sees me doing it constantly, and he picks it up, and he has his own portfolio that I allow him to choose his own companies because I want him to learn and make mistakes. I mean, and to hear how you've made those mistakes and how far you've come. Honestly, it's an inspiration for me and for my son. But since you've come along from that, what is your purpose then from an investing point of view right now?
Oh, wow. Well, I'll tell you, my purpose at this point is to, one, avoid making more mistakes, because I'm kind of far along enough where I've made enough mistakes, and I certainly don't want to face any major setbacks at this point. And so that's one of the things I actually discussed in a recent video, is just I do speculate sometimes, but when I do, I try to keep it within 5% of my portfolio. And I look at that 5% over the long term as well. So if I've lost money, I have to make that up or I have to increase the rest of the portfolio in size before I can place more in speculation. So I have strong rules around that. But for 95+% of what I'm doing with dividend stocks, my goal at this point, honestly, is just to keep doing what I'm doing. I own 50 stocks right now. Honestly, I don't want to own too many more stocks. So when I do add new stocks to the portfolio now, it's more of a rare occurrence. But I'm really focused on this point at just building up my cash flow. And so at some point in the future, I do want to live off of dividends. I would say part of the dilemma I face, honestly, living in the expensive San Francisco Bay Area. I'm married with 2 kids, a 3-year-old and my son's almost 6. It's expensive. And there's almost this delusion at times where and that's part of life, honestly, because you have to have these big goals. You have to have these goals that seem almost unrealistic, because if you're not shooting for the stars, what's the point? It's not it's not very exciting just to try to get by, to try to, not do your best. But what I'm saying is the cost of living is so enormous that there is a delusion that I tell myself I am going to live off of dividends. But when you actually put the numbers on the paper, it's going to take me some time. And recently I was actually inspired by one of my wife's friends, because she said, she provided, basically this, she was just telling my wife, I'm trying to retire, within the next 10 years. And that kind of triggered in my mind, that's kind of what I want to do as well. That was a good idea. And so at this point, I want to keep doing what I'm doing. I want to keep adding money to the dividend stocks. Within 10 years from now, honestly, I do want to be, in one way or another, living off of passive income. Now, will I retire from my job? Will I retire from what I'm doing? Probably not, but I want to have the comfort of being able to slow down. I want to have the comfort of having the cash flow cover everything. And so what I'm saying is I'm becoming more and more open these days to the idea of even geographical arbitrage. At one point, I was just completely closed off to the fact that, hey, you're going to leave California, or you're going to leave the San Francisco area and go somewhere that's more affordable, because if I did so, I could probably get by right now off of the dividend income. And I could probably right now, I would have to supplement that with some YouTubing, maybe even ramp up what I'm doing on YouTube and do a little consulting, but basically I'd be there. But one of the dilemmas I've always faced, honestly, is, and I think it's something that maybe it's like a generational thing. Like when you look at like my parents' generation or my wife's parents' generation, like an average family, they could buy a house here very affordably and kind of have a really good, like all American kind of American dream lifestyle. But these days, that American dream lifestyle, it's kind of reserved for the ultra wealthy, those who have done very, very well in the tech industry, at least in this area. And so, but for me, it's always been this dilemma that I'm unwilling to give up this concept that, well, if my parents could do it, if my wife's parents could do it, why can't we? Why can't we do it here in the San Francisco area? And so it's kind of almost a challenge I put before myself. It's this challenge that I want to do it. I want to make the impossible happen. But honestly, trying to live off of dividends here in this area, for someone, who hadn't made just a huge windfall from a tech IPO, it's tough. And so for me, honestly, it's a long answer to your question, but I'm always in my mind trying to rationalize these different pieces of the puzzle. I'm kind of playing this game of chess in my mind and always trying to adjust strategy and figure out. But the guiding principles for me is 10 years from now, I want to be covering my living expenses with the cash flow. Doesn't mean I have to retire. Doesn't mean I have to, just sit back on the beach. I want to try to make it happen here, but if it doesn't happen here, certainly we're open to other alternatives as well. And just trying to always rationalize those different options that are out there. Now, above and beyond that, that's all selfish stuff. When I kind of think also just about bigger picture and like impact, I love what I'm doing on YouTube right now. And I know YouTube probably feel exactly the same with all of your great insights on the blogs, on Twitter, on the podcast, that there's this element of just connecting with other people. There's this element of the dividend community. There's this element of each of us helping each other out along this journey. And I would say that's a big part of what I'm focused on now as well, is just connecting with people all around the world. This is actually my first kind of guest appearance I think I've ever done on the topic of dividends. And I'm very selective. And the reason I was immediately, when you guys asked me, I chose this opportunity is because of the global nature of this podcast. One of my favorite things about dividends is it really unites us all around the world. It's not just one country. We're all in it together. And so there's that element of it as well that, I kind of, at this point, I do think at a certain point it will be inevitable that I'm going to reach my goals on cash flow. Maybe it's not here in the SF area, maybe it's elsewhere, but what's next? What's kind of a bigger picture? What's a legacy I can leave behind? It's the YouTube channel. It's getting those videos out there. And like yourself, EMF, it's also the children as well. And so I'm also thinking quite a bit, how can I educate my kids about their future and about dividend stocks if it is something they want to be involved with in the future. So long answer to your question, but there's always, and it's adjusting every day. I'm always thinking about these types of big level topics.
Yeah, geographical arbitrage has always fascinated me because you build up a lifestyle where you live and you have friends, you have family, and some people make it so easy to just uproot and leave and move somewhere where it's cheaper. But I mean, you're moving away from your whole life, and I could not imagine doing that. I don't know how. I could not imagine doing that. So it sounds good, and it might make financial sense, but part of my financial independence is being happy, and I want to spend my time with my friends and family that I live around, and not move to halfway across the world to deal with that.
Yeah, that's a great point. And I would say for us, we're probably similar. Now, one of the things that's exciting about here is there's so much land. In California is such a big state that even if we moved about an hour and a half or 2 hour drive away from where we are, the home prices get cut in half, or even you get cut in thirds. It's like 1/3 the cost for an even bigger home than you get here. And so for me, that I would entertain something like that, because we could still drive a few hours and see family, see friends, meet in the middle maybe. And so there's kind of that element. But to your point, if it were meant moving elsewhere in another country, that might be a little bit out of my comfort zone. But I do know that there's investors out there in the community who have done that successfully, and who love it, and who I follow online. And I think that everyone has just their own goals, and there's no one right or wrong way. It all comes down to just some people just have different kind of personal preferences, and some people honestly they prefer moving to a different country because I think they're more like, I would say, just have that spirit of traveling and discovering new things, and kind of being more adventurous and maybe even more entrepreneurial in some ways, that they feel like, wow, I'm going to really go out there and try something different. And so that's not necessarily how I am, but I really do respect folks who are going that route as well.
Yeah, I agree.
And what is really interesting, Ian, when I hear you talking, and I don't know how you look at it yourself, but I always have a feeling you're an entrepreneur more than anything else. If I look at your what you share in your videos with the real estate as well, doing some angel investment here and there. And I wonder always, like, an entrepreneur, you cannot put in a cage, not even in a financial independence thing. I cannot even imagine you sit quiet in your garden. I have a feeling you will always be out there in the fields doing the stuff you enjoy.
I think you're right. And for me, it's somewhat of a game. I look at dividend investing as winning. It's kind of beating the system, hacking the system. And for me, I feel kind of it's getting to that point when you reach financial freedom. Surely I would probably take a little more time off, but I have other interests in life which I don't fully pursue right now. Like, I would like to get into some longer distance running than I'm doing now. I'd like to perhaps one day run a marathon, but that would require a lot of training that I don't have time for right now. But certainly, absolutely, it would be really tough to just completely pull out of everything. But I would certainly take more time for myself. And I think it's also just the freedom of knowing I can do whatever I want, whenever I want, and having, nothing holding you back, if you will, and kind of finding a way to free yourself from this system, kind of hacking the system, if you will.
Yeah. So, and then that's something that I struggle sometimes with. It's because it's mental, right? It's something mental. And for instance, I sometimes have a feeling that I'm investing now for the future, but not my money, that I'm also investing my time now for the future, because investing takes a time, takes an effort as well. It's also passion. And the only thing I wish I get better in is living in the now. and not living 10 years from now when I have the financial and then regret that I didn't live today, I don't know, to be enough with my kids or something like that. That's the only kind of bad feeling I have sometimes in my mind about pursuing what I'm pursuing now with the family around financial independence.
That's a really valid point, for sure. And I think someone, I forget who it was, but someone recently posted a quote on Instagram or Twitter. I think it was from one of those books about Warren Buffett. I don't remember which one. It's been years or even decades since I read it, but one of them was like Buffettology. There's some others, and I think one was called like The Warren Buffett Way. I don't know which book it was from, and I think this may be out of context, but someone basically put like a screenshot, one of the dividend investors in the community, and it basically was like some kind of piece of advice to Warren Buffett's kids from I guess his wife, saying like, hey, don't expect too much of your dad. Like, don't expect him to spend too much time with you because he has like a really special mission in life. Like he's doing something really special and different with his investing. So unfortunately, as like a father, you can't expect too much from him. Like, I think that's kind of the gist of what the book was saying. And that really hit me when I read that, because I'm like, that, you know, who shared this? It was Marco on Whiteboard Finance. I think he was the one that shared this. I was on Twitter, I think. But anyway, I thought that quote really hit me because it does give perspective that, you know, you could be too focused on something. You could be too focused on a particular, you know, on investing, on dividend investing, to the point where it becomes an obsession. And that is not necessarily healthy. Yeah, you could be the best investor in the world like Warren Buffett, but does that make sense or not? It's all about that balance. And I think that's honestly why I'm so attracted to dividend investing, because other forms of investing like trading stocks, day trading, you're tied to the computer more, you're tied to the news cycle. Where dividend investing, sometimes on the stocks I own, it's kind of embarrassing, but people from the community bring me news and they're like, Ian, what do you think about PPL Corporation, which is a stock I own? They just sold off their UK division. I didn't even know about this until someone from the community asked me about it. And so, but that's the great thing about dividend investing, is literally I don't have to watch the stocks day to day. And so it frees up some of that time. And I think that's why I'm so attracted to dividend investing, because it is kind of that investing that's more of a lifestyle balance compared to many other things.
Yeah, and that's good that you mentioned it, because that's also why EMF and I started this podcast. It's really for the community, because I think we have really a great community and lots of questions. And I think as a community, we're just so much stronger and everyone plays its role in it. And, you know, there are people also on social media with, I don't know, 20 followers, but some of them, they give me the most value. Yeah,
That's
really,
right.
really great content. And yeah. To switch a little bit towards the European flavor now, do you own any European stocks? And do you have a certain perspective on stocks from Europe in your investing?
Absolutely. So I do own European stocks. My favorite one is Unilever. That one I'm really proud of. It's performed very well. It's kind of a classic PPC Ian stock. Some people call me CPG Ian, consumer packaged goods, because I really do enjoy those types of companies that provide consumer packaged goods, both food and beauty products and household products. And so Unilever is a natural fit. It's been one of those stocks I've owned for a very long time. And I also own some other European stocks as well. I'm trying to think. Some of them are Danone. So that's one that I own. I really like how they have a health food focus. They're more focused on healthier alternatives. And I think that's so important, because as a just global community of humans, one of the trends in our world these days is I think so many people are not thinking about their health. And I don't even blame people, because the modern lifestyle, it's difficult. Like, everyone has to work so hard, and you know, you just to make ends meet, and there's to earn enough money to pay rent or pay your mortgage or figure everything out. And so sometimes people aren't always as health conscious. They aren't making necessarily best choices, myself included, honestly. And I like owning a company in the portfolio like Danone that does provide healthier options. I own a few European energy companies, Royal Dutch Shell and also BP. And I also own a British American tobacco company, BTI. So I own that SIN stock as well. And so I do have a variety of European stocks, and I love owning European stocks, global stocks. One of the things, though, that I also do is I own American companies that have a really good international focus. So one of the things I really think is fun is I track sales for each of the companies I own, and I track how much comes from like the US. Sometimes they don't report US, they report US and North America. So it's just like all of North America. And then they track like international, global. And like one of the companies I own, Colgate Palmolive, most of their sales are coming internationally. They're not coming from the US. I think US for them is like less than like 30%, like 70% of their business or so. These numbers aren't, I haven't looked at the 10K recently, but so they're very ballpark, but most of the sales are coming internationally. And so that's another way I look at it, is that I try to manage my portfolio so that I diversify revenue across the entire globe, because I realize I don't want to put all of my eggs in one basket. I don't want all of my revenue coming from the United States, where that, United States is a strong country and has a great economy, but we don't know what the future holds. We don't know what's going to happen. And there's a lot of emerging markets around the world that are growing quicker than the United States. And Colgate gives me a lot of exposure to those. I know Danone, for example, is really big in that market as well, with some nice exposure to emerging markets. And so I definitely am a fan of global investing, and it's always been one of my charters, just of my YouTube channel, and also for my portfolios, to have that global perspective. I would say the challenge I have sometimes with global companies, and why I really love what you two are doing, is I lean on the community a lot more to get the knowledge, to get the analysis, because analyzing statements like 10Ks, 10Qs on US companies, it's on a very certain format. It's in a very specific way. It's very standardized, and it's easy for me to understand. And I just understand when everything is denominated in US dollars. But when I start looking at statements in euros, for example, and I have to convert it back to dollars, and I'm just trying to make sense of what does that really mean? How does it stack up against my other companies? And I'm trying to compare companies in different currencies. For me, and just knowing that some of the things I rely on, like the analyst forecasts, I get them really easily for all my US stocks. It's sometimes the analysts, at least the data sources I use, I don't always find the same forecasts for my European stocks. And so it's another layer of complexity. But that being said, it's worth the extra effort for sure. And I'm really blessed to have, friends like yourselves who provide a world of information to your friends here in the United States, so that we have a better picture of what's going on, and it makes it a little bit easier to invest globally.
Yeah, and I think Danone is a really interesting company, because we have discussed it a lot in this show. And they just literally cut their dividend with 8%. So we were, EMF and I were not too happy. So we sent out a tweet and we tagged the CEO, and a few days later he was fired. But so we're having, and we had the same with Intel, I believe, that Bob Swan got fired straight afterwards. So we have this aura around us that we shouldn't tag any CEO anymore on Twitter, because two times it happened, and 2 times they are gone within a week. But I'm totally with you with Danone, and this is a thing that we struggle with, is with the there's not so much respect in Europe for dividend history and dividend growth history, because for a company like Danone, after more than 30 years, to cut their dividend by 8%, it feels like they're just teasing the shareholders.
Yeah.
Like they would do it on purpose or something like that. Because if you look at their numbers, their cash flow, it was totally not needed. There's no reason for doing it. So that makes it also, I think, sometimes in Europe harder to to base your retirement plan on European dividends, and that's what we usually struggle with, really. And that's something I hope will change, but it has to do a lot with how the philosophy is structured in Europe. So most of the companies, they have a dividend policy where they say we pay up to 50% of our cash flows, or around 50%. And if you have growing revenues in good times, in the longest bull market, you have a growing dividend, and it almost manipulates us in thinking that it will continue growing, and we start forgetting about the dividend policy. So for us, it's really important to be diversified. And secondly, it's even more important to do the homework around their strength in the crisis, because we cannot count on management to look after us at the times we need it from a dividend point of view.
Yeah.
And maybe Unilever is one of those few exceptions. But I have on my website the Noble 30 European Dividend Aristocrats. I think there were 5 dividend cuts in a single year out of this. And this makes it hard for us here.
It's really difficult, and I think it's good that you're bringing this up, because I feel that when some people reach financial freedom, it's important to have a buffer. So it's kind of if you are going to live off of dividends, it's probably wise to have more dividends than your expenses, have a little bit extra, and build up an emergency fund from that excess cash flow, because we have been in really good times over the past decade or so. And so it may not always be that way. I have faced dividend cuts in my own portfolio during the pandemic. One of the complete dividend suspensions was a company I own called Cedar Fair, which is a master limited partnership. They own some amusement parks in North America. And we know that some of the energy companies as well had. Now, thankfully, my cash flow continues to march forward because I keep adding money, and also a lot of companies increased the dividends during the pandemic, and so that's why I like to diversify so much. But I think one thing I always keep in my mind is, as I head closer and closer towards that financial freedom, I like to have good diversification within the dividend portfolio. I want to have an emergency fund. I want to have excess cash flow just in case there are cuts. And also, I like to think about multiple streams of income. So I do have real estate deals that will spin off cash flow. And I also look like, what am I doing on YouTube? I do it because I love what I'm doing, but it doesn't generate a enormous amount of revenue or anything, but it is a nice side income, if you will. It's supplemental income to my main job. And so I feel like, as anyone in the community is getting closer towards financial freedom or thinking about it, it may be wise not just to think about dividend stocks, but to at least complement it maybe with one other stream of income. Like, hey, and it doesn't even have to be a lot of money, but is there some kind of freelancing, even like if you're really good with graphic design, could you get on a global freelancing platform like Fiverr or Upwork and try to provide your talents on there just for a few hours a week? They're always keeping your options open, because it is true that sometimes the unpredictable can happen with dividends. And I was pretty surprised by the Danone dividend cut as well. And I agree. It kind of feels like they just kind of did it they didn't have to do that. There was no business case for it. I understand with the energy companies, look, they had to do it. And I commend them for doing it. And I fully support it. At this point, I would, rather than the energy companies increase the dividends quickly, I'd rather have them keep it low so they can pay down debt and get their balance sheets back. I'd rather have that happen. And same with Cedar Fair. I'd rather have them just wait a little bit, get back on good financial footing, pay down some of the debt, figure that out before paying the dividend. But with Danone, it did seem like a little bit of a different kind of case there, where it might have, I don't know if it was politically motivated or what maybe it was even pressure, just kind of peer pressure, or that's where I really look at kind of the intelligence from the global community on what's really going on there. Is it something that was why did it happen?
There's a lot going on now in the French newspapers about what's happening with Danone, because there's an active investor in the management board that's really shaking things up. French people have a really strong, I don't know how you call it, but it's always about the union and for the working people. And I think there is going a kind of, house of cards going on at the moment in Danone. There's a lot going on there, which is probably doesn't deserve daylight at the moment from a boardroom point of view. But I would love to be the fly on the wall.
Absolutely.
That.
Well, I'll tell you something, and I could be completely off base here. I may be completely wrong, but the sense I get is in a lot of what's happened in Europe, which is generally speaking higher tax rates, kind of more, correct me if I'm wrong, because I'm not a European. I don't know. I've only visited a few times, but I sure wish I could visit, because literally I'd rather probably live in Europe than here. I just love the culture and the architecture and the history, just the whole lifestyle. One day, one of my dream goals is to spend an entire summer in either Paris or London, or maybe both. One of the kind of, just as an American, one of the things you hear and you kind of get a sense is that taxes are higher, and there's more of a skepticism towards people who are really wealthy, and that they ought to be taxed, and that tax revenue ought to be used to help redistribute wealth or help out those who are less fortunate. And when I look at that, and I correct me if I'm wrong, but I also look at kind of the United States. One of the things, you start feeling that vibe here as well. And it goes back to our topic of taxes earlier. And you asked like kind of a little bit about taxes. I personally believe that taxes will continue to increase in the US. And I'm not advocating for that. I'm not saying I agree with it. But what I'm just saying is I try to look at the facts, and I try to, in an unemotional way, just understand what's happening and what's my reality going to be. And anyways, I was just driving yesterday. I was on the road. I was so tired today. Because I was driving to see a real estate deal, like 3 hours each way. And basically, one of the things I saw when I was driving home is someone had a bumper sticker on their car. This person, they like cut me off. They were driving really fast. And then it said on their bumper sticker, "Tax the rich." And there's this concept now in the United States now that the rich, they're not paying their fair share. The rich, let's tax them more. And I think a lot of people get it confused, because the rich, who are the rich? Is it people who, like myself, who have worked really hard and earned a lot of money just through hard work? Or is it is it a company? It's not even a person. It might just be a company. You hear these stories all the time of the companies not paying their fair share of taxes. And so, but sometimes with the everyday person, I don't think they're even thinking to that level. They're just thinking, whether it's a company, whether it's a person, whatever it is, there's people out there and they're rich, and we need to tax them. And then you start thinking about things like this, and it kind of, then I think, oh, well, why did Danone cut the dividend? Is it just something as simple as that tax the rich company? The shareholders shouldn't be receiving that money because they already have enough. They're already rich enough. Don't do it. Maybe instead of paying the dividend, everyone who works there should get a bonus or get their salary.
In France last year, when the coronavirus broke out, there was a lot of companies were in the spotlights with the dividends, and the smart companies didn't cut it, but they postponed the general meeting until the summer in a hope that things would blow over. And that's why many of the consumer staples, specifically in France, were still able to pay a dividend, because at that time, I think in April, it felt like it's really about naming and shaming. And it comes to, in the end, it comes to solidarity. I think that's the European philosophy, not having a too large wealth gap, and solidarity. And that's really deep into our system and into our belief systems. And that's also why many Europeans don't look with a lot of pleasure to America when it comes to the greed, because that's the other opposite in the perspective, right?
Yeah.
And it's just different cultures. I'm not here to judge what's better, because I cannot judge it from an American point of view.
Absolutely. And I don't know what certainly I want to be clear. I'm not trying to make a political statement, and I one way or another, I'm not saying one is right or one is wrong. What I'm kind of trying to get at is, to me, it seems that, and this is something that has risen more and more in recent years here in America, I feel it a lot. I feel it in the Bay Area, that there's a skepticism amongst people about the rich, the quote unquote rich. And so just as a dividend investor and someone who looks at things pragmatically as it pertains to, well, what does my future hold for me? I think I'm not saying that there's no future for dividends. Of course there is, but I think as dividend investors, we all have to be careful. And it goes back to that point about trying to have a buffer and not just barely getting by on dividends, but having a little extra, and maybe even having some side hustle or some freelancing, other means, multiple streams of income, if you will, because you just don't know what will happen in a world where there are political dynamics and no single person can control those dynamics. And so it's very wise, in my opinion, just to plan ahead for change.
So this is one of the reasons why every year, and I did it also now, I make my own 3 financial statements. Because I analyze my own wealth as if I would be a company and want to invest in myself. So what are my income streams? Are they reliable? What's my return on investment? How does my cash flow look like? How does my balance sheet look like? So I have a 12% debt on equity I calculated. Yeah, do I feel comfortable with that? How much are my cash and cash equivalents as well? So I do this actually for that reason, because that kind of then tells me whether I have a cushion or a margin of safety here as well. Because if indeed my dividend will be cut, it doesn't need to necessarily that I need a 10% of money margin of safety, but maybe I just need a second income stream, right? To have a better product market matrix or something like that combination.
That's really cool.
So that's the end of part 1 of this series. We'll have a second part coming up shortly. I think you'll all agree that Ian has kindly shared a lot of knowledge during this episode. Next week, we will be asking a couple more questions, but we will also be asking the questions from our community. So stick around and we will see you next week. Thank you.
Just want to be careful to mention that what I've mentioned today, it's not financial advice. It's just my personal journey. I'm just sharing my journey for fun and entertainment, and certainly I'm not a financial advisor. And folks out there who want to get into investing or are already in investing, it's important to find your own advisor if that makes sense for you out there. It's just sharing my journey today for fun with all of you.